All right. May 8th, 2025 here. James Griffin alongside Nick Murata here with YMW Advisors. And we're going to talk a little bit about what's going on in the markets today and any kind of economic news. We're going to talk a little bit about the four-step bottoming process. Ned Davis kind of clearly defines and where we are in that process. We'll talk a little bit about earnings, some of the leading indicators that we're keeping an eye on that will show us whether we're strengthening or weakening as a stock market. And then rates, right? Obviously, rates have a big impact. And what the Fed does, we know that they've chosen to stay where we're at right now. So that's what we're going to talk about today, Nick. And we're going to throw a little fun in there as well, I think. So I have some tricks for you, some things here. So obviously disclosures here. None of this is a recommendation. Both of us are certified financial planners, but we may not be your certified financial planner. So obviously take that with a grain of salt. This is for entertainment purposes only, we'll say. So Nick, let's talk through a little bit about the four-step bottoming process as definition sits here, and then in the next page we'll talk a little bit more about how it looks like on a chart. So kick us off here.
Yeah, so last video we were kind of in the initial rallying stage, and a lot has changed in a very short period of time. But traditionally, this is a bottoming process that we look for a sustainable or runway or sustainable rally. And generally, it starts with an oversold condition, which, if you think back, it's not too far in distant memory. It's actually 1 month ago. April 8th and April 9th were some of the most oversold readings we've had in the last 80 years. Very significant. Sentiment levels got very, very pessimistic. Market tends to do that in a waterfall decline. It oversells, and then eventually some buyers come in and there's some type of rally. So we experienced a pretty short-lived rally. We didn't get really the conviction in the rally that says we were out of it. So usually what happens is that's the second time for someone to sell on that initial rally. And we usually retest our lows. And if we can hold those lows, that's considered a successful retest. And what we want to see is less selling pressure on the downside for that successful retest, which occurred. It wasn't nearly as dramatic as the first oversold condition, less severe breadth measures, but we didn't quite get down to the lows. We were within 3.5% of our lows overall. Yes, we can consider it a successful retest. It would have been nice to get a little bit closer there to really show that there was conviction at that particular level. But then coming out of that, we had, I think, a 9 days in a row consecutive up market. And eventually that fired off on what we call our breadth thrust indicators, which is just a variety of different indicators that Ned Davis has of a breadth thrust watch report to show widespread buying, conviction in the market that historically has led to really, really strong returns. And so when 5 of those 10 fire off, we consider that a breadth thrust, if you will, and we are just at 5. I'm not going to say thrust anymore in this conversation or breath anymore in this conversation. So anyways, so we've had that. So that gives us a little bit of conviction that the behavior in the market has obviously changed, and we're a little bit more, risk on than we were before. So this is visually a chart. Step 1, waterfall decline. I think this was Liberation Day here. Step 2, initial rally. This was the pause in tariffs, the big up day here. So we had this initial rally. And then this was the retest. I put a little question mark there because we quite didn't get down to our lows, but I'll consider that a successful retest. And this is the final leg here of completing potentially a bottoming process on a short-term basis.
Yeah, and to maybe, give an analogy of these 4 steps. Step 1 was when Nick approached me about, selling the practice over to me. So he's like, "Hey, James, I'm ready to sell this practice to you in its entirety. How much will you give me?" Step 2, he bought lunch for the team here, which is very nice. Step three, he actually approached our intern and had the same conversation about selling the practice. And step four, I'm hoping that there's a free lunch here coming up, maybe a dinner. So I feel like the further we go in these steps, the more likely I am to get fed, and I feel pretty good about that.
Yeah, yeah. Don't keep your hopes up, but historically, when those breath indicators go off, it has happened 28 times since 1980, and the average median return has been 17%. And there has not been a time 252 days later that the market was actually down. So, from a conviction standpoint, I think there are legs here. We can still go through some downs, but we may have seen a bottom just based on the technicals. What's different than historical patterns, though, and with history, we got to use history somewhat as a guide to see where we're going in the future. Otherwise, you're just guessing. But things change, and so can it always be accurate? No. And is there potentially more trading and algorithmic trading that goes on that pushes things higher and lower than historical patterns? That could be the case as well. But from just kind of a broad conviction standpoint, this is at least a plus in the pros column for a bottoming process.
Yeah, and I think that obviously uncertainty leads to volatility. And if we look back at some of the books of President Trump's written on negotiation, they've all kind of talked about the negotiating process he uses, which is creating a high level of uncertainty and unpredictability. And so maybe this is just the market looking at everything we've seen and saying, all right, there's been a lot of talk here, but people are kind of digesting that better. So yeah, obviously we have soft and hard economic data, and I'll let you get into more of the specifics here. But my analogy with soft data versus hard data really is soft data is if you're working in corporate America, it's how great they treat you. Hey, we love you. You're doing an awesome job. You exceeded all of our expectations. And that's kind of what they tell you, right? The sentiment's very good. They want you to feel good. Hard data would be, well, your in review comes along, and you get the standard 3.5% raise. So you're not extremely happy about that, but it's an actual data point that tells you what you've done. So talk a little bit about how soft and hard data applies to the economy and where we're at.
Yeah, right now, soft data is bad. And that's why we're really pessimistic. And that's why our sentiment indicators have been very negative. And sometimes we get too negative. The question is the negativity predictive of what will happen in the future? Um, I have talked to people that are very, very negative on the economy, but they're going to still spend money. As long as they're employed, they're going to spend money, and that they may feel really bad about it, and their forward outlook may be bad, but they're still going to maybe buy on a dip, and they're still going to, go out on the weekends. But right now, the soft data is bad, and generally, it's a predecessor to hard economic data. Uh, Unfortunately, hard economic data is lagging. So we just got our GDP number for last quarter. So that doesn't really help us too much. We know it was slightly negative. We don't know what this quarter will be. Employment statistics, the labor market has shown some cracks, and it might get a little bit worse overall. But is it enough to push things over the edge? We don't know. But still fairly resilient. So if you wait all the way till you get the hard data, sometimes the market has already uh, priced that in to a certain extent. The market does a really good job of trying to anticipate what's going to happen. And sometimes it's right and sometimes it's wrong. But if it's wrong, then it corrects. And if it's right, it kind of has already been priced in. So we've went down based on the uncertainty of the tariffs. We've gotten a little bit more certainty. What we got a deal today. Market's reacting to that. But I think the next hurdle is we're going to start getting some actual data of how this has affected the economies and goods and inflation and so forth. So earnings coming in, that's last quarter. Earnings have coming in have been pretty good, and other than energy has been really bad. And energy makes up less than 5% of the market cap of the S&P 500, but it's affected earnings by 26%. We've got these stats from one of our buddies at Warren Pye's research, 413 research or 314 research. But basically, energy has taken an outsized chunk of the earnings. When we take energy out, earnings beat rate has been pretty good overall. A lot of forward guidance has been pulled. Some forward guidance has just stayed the same. They're saying, well, this is a temporary thing. We're not going to pull our guidance. But some have gotten this bimodal guidance of saying, well, if we go into a recession, this is what it'll look like. If we don't go into recession, it'll go like this. So kind of hedging their bets. One thing I haven't seen really is analysts have not come down with their earning estimates. They usually come down by this time of the year, on average about 2 to 3%, which that's all they've come down so far this year. So that's pretty normal. They haven't revised earnings down anything more based on what's going on with Doge and the political uncertainty and the tariff uncertainty. So I wouldn't be surprised if we get more downward revisions moving forward as time goes on. But again, that's hard data that we're going to get later on in the future here.
Yeah, it's so hard to look at some of this hard data because some of the consumption that we've had or some of the purchases that larger companies have made have been around preparing for tariffs. So what part of those purchases or decisions were normal decisions and what were just, building inventory for potential increased input cost.
Yep.
So
So we started this webinar talking about some good news, right? From a technical perspective. And market's gone up pretty quickly in a short period of time. So maybe we're on a short-term basis a little overbought. But at the same time, I'm going to give a little bit on the other side is we do follow another indicator, which is a leading economic indicator. It's 10 different indicators. It's proprietary to Ned Davis, and it has been helpful in terms of forecasting a more prolonged downturn or potentially a recession. But it can go in and out of buy and sells. And we just had a sell signal that was triggered. That says May 1st, 2024. That's wrong. It was May 1st, 2025. So I apologize there. But the 8 of our 10 indicators are now bearish. This suggests kind of caution for investors. So at the beginning, I felt a little better, but our leading economic indicators are actually showing that we should still remain cautious overall. And I'll just show you a chart here. These are all the buy sell signals. So you can get whipsawed. You can get a sell signal and get a buy signal right afterwards. This was 2008, 2009. They gave us a leading economic indicator sell signal, which was very, very helpful in terms of reducing equity exposure. But it can go back and forth if we don't have a more prolonged downturn. So just because we win here doesn't mean we can go right back onto a buy signal overall. But historically, this has been helpful in kind of evaluating the overall economic and leading indicator environment. So another side of the coin for what's currently going on. You want to talk about the Fed a little bit, James?
yeah, definitely.
Jay Powell, your buddy?
Yeah, Jay Powell, him and I go way back. And so obviously, we've come from a stance interest rate perspective here in the last 5 years. We went from extremely low interest rates and we aggressively hiked those rates. Obviously, in the last couple of years, we've had better money market yields for retirees and whatnot. And so I think the big question comes in is when will or whether the Fed will intervene. And Jay's made it clear that he's still trying to see the ramifications, probably looking for more hard data, right? So he's not necessarily looking at the soft data or the volatility in the markets, but really more interested in what kind of data starts to show itself before he starts making decisions on rate cuts. Obviously, rate cuts are beneficial, and we have a chart coming up here in a second that will show how that impacts the markets. But yeah, so right here, what this is showing you here is that after a 10% correction, in the S&P 500, more times than not, the market's up, right? If you look out 1 to 5 years later, the longer you look out, the more apt the market's going to be up. But when you throw a Fed cut into a 10% correction, the S&P 500, if you look at that green bluish line, obviously there's a higher increase. I mean, when I look at this, Nick, I'm not sure what you're seeing, but when I look at that immediately downturn from that blue, and then it kind of crosses over the red line, it makes me think that correction was uh, due to probably a lot of uncertainty in the market, and therefore you saw that come down quicker versus the red line of no Fed support. But as those rate cuts come into play, you start to see people look forward. The stock market is forward looking. It's obviously not worried about yesterday's data as much as it's worried about you know, do we see now and how is that going to impact us going forward? So obviously people see that rate cuts can help with all sorts of things as it relates to borrowing and real estate activity. But yeah, Fed cuts would be good. So right now we are at a point where there are no changes, and um, we'll have to see what kind of comes out here before their next meeting, and whether it will be a rate cut or not.
Yeah, next meeting is June. There'll be more hard data that comes in there. May unemployment. The Fed has the dual mandate for inflation and unemployment. So if unemployment starts uh, creeping up, that could prompt something, even in the face of potentially some higher goods in inflation. The market's still pricing in 3 rate cuts for the year. We can see that on the yield curve of treasuries. You're getting the highest yield for 3 months, a little bit less 6 months, a little bit less 9 months, and a year. And really, the 1 year, or excuse me, the 3 month yield on a treasury, you have to go all the way out 10 years to get the same amount of yield overall. So we'll have to see. They'll look at the data and make their decisions from there. We can't necessarily count on the complete, but I do think there's ultimately, a Fed put at some point in time. The question is, are they going to be too late if, a domino effect occurs overall?
Yeah, I mean, I guess we could go to the next slide here. But I mean, look today, obviously, a deals kind of come out here today with the UK. We're seeing some certain parts of the industry impacted by this: auto, steel, aluminum, U.S. beef, aircraft supply kind of deals being made, and obviously other countries are looking at potentially making deals too. And these deals could take months to kind of come to fruition. So, as I think through this visual that you put together on the right here, Nick, I mean, big picture, if we wait for those deals to be done, then you're probably going to be behind the 8 ball. So if you're sitting on cash or assets that are long term, it's good to line those up. So lining long term assets with long term goals, because obviously by focusing on the short term for long term assets, you could miss out on some of these things coming to fruition and really pushing the market higher before it feels good. But I'll let you wrap up today's call, Nick.
Yeah, ultimately, due to the uncertainty, it made sense to be a little bit more defensive. We're kind of cautiously back to neutral. Coming from such extreme negative sentiment leads these powerful rallies. Could it still be a bear market rally? It could be. I think it's yet to be determined. I don't think there is any kind of certainty where you can kind of forecast out what's going on at this point in time. It's very possible we can have a V-shaped recovery. When pessimism gets really low, expectations get really low, and we have a low bar to jump over. So when GDP number came out, the market was down a little bit. I think by the end of the day, it was up. So we kind of already, the market does a good job of already pricing in those expectations. So we just need not the news needs to be better than kind of what is expected. So it can still be some bad
Mm-hmm.
news, and we know there's going to be some temporary pain with the tariffs overall. The question is, how long is that going to last, and what effects has it had? And that's yet to be determined. But I don't think you want to be at this point in time. I don't think you want to be too defensive. or too much offense. You know, you probably are just back at neutral, and that's kind of what we're saying overall.
Good deal. Thanks, Nick. Thanks for your time.
Yep.
Until
Thank
next
you.
time. All right.
All right. Bye.